There is a promise being made in the income investing world right now, and millions of people are buying into it every single day. The promise sounds like this: buy this ETF, collect the monthly distributions, and live off the income. You don't need to wait 30 or 40 years to build a massive nest egg. You don't need $2 million sitting in a boring index fund. You just need the right high-yield product, and your portfolio starts paying your bills right now. And honestly, I understand why people fall for it. In today's economy, where groceries cost more, rent is brutal, car payments are through the roof, and the idea of ever owning a home feels like a fantasy for a growing number of people, the idea that your investment portfolio could step in and cover some of those expenses is incredibly appealing, almost irresistible. But here is what nobody is telling you clearly enough. A large number of high-yield income ETFs, the ones advertising 30%, 50%, 60%, even 80% annualized distribution rates, are not actually paying you income. They are paying you back your own money, slowly, quietly, every single month, dressed up as a dividend. And while your bank account gets a deposit every 30 days, and everything looks fine on the surface, your share price is drifting lower, your NAV is eroding, and the income-generating power of your portfolio is shrinking right underneath you. And the cruelest part of all? Most investors don't realize it's happening until significant damage has already been done. So today on Dividend Desk, we are cutting through all of it. We are going to talk about what NAV decay actually is, and why it matters more than most investors think. We're going to talk about the difference between real sustainable income and what I call yield theater, high distribution numbers that look great until you actually examine what's behind them. We are going to talk about why growth plus income funds represent a genuinely different and better approach for investors who want to actually live off their portfolios. And we are going to talk about the bigger economic picture, why so many people are turning to income ETFs in the first place, and what that says about where we are as a society. This is one of the most important topics we cover on this channel. So, let's get into it. Quick disclaimer before we dive in: nothing in this video is financial advice. Everything here is purely for educational and informational purposes. I am not a financial advisor. For guidance specific to your own situation, always consult a qualified professional. Part 1. The two worlds of dividend investing. Let's start by getting clear on something that I think a lot of investors never fully think through. The fact that not all dividend and income ETFs are built the same way, and the differences between them are not minor. They are fundamental. On one side of the spectrum, you have your traditional dividend ETFs. These are funds built around companies that have long histories of paying and growing dividends, your large cap value names, your dividend aristocrats, your consumer staples, and utilities and financials that have been writing checks to shareholders for decades. Funds in this category typically yield somewhere in the range of 2% to 4% annually. Not exciting numbers, not the kind of yield that gets people clicking on YouTube thumbnails. But here is what makes them genuinely powerful for long-term income investors. The income is real. It comes from the actual earnings of the underlying businesses. And because those businesses continue to grow their earnings over time, two things happen in parallel. The dividend tends to grow year after year, and the share price tends to appreciate alongside the dividend growth. So over a long enough time horizon, the income investor who holds these funds gets a rising income stream and a growing portfolio value. That is the definition of sustainable income. The catch, and it is a significant catch, is that you need a lot of capital to make that model work for covering real living expenses. A 3.5% yield on a $100,000 portfolio is $3,500 a year. That's $291 a month. That doesn't cover much. To generate $3,000 a month from a 3.5% yielding fund, you need roughly $1 million invested. And for most people, especially younger investors or people who got a late start, that kind of capital base is years or decades away. So naturally, investors start looking at the other side of the spectrum. The covered call ETFs, the option income funds, the products advertising 15%, 20%, 25% annual yields paid out monthly. The math looks completely different. A 20% yield on a $100,000 portfolio is $20,000 a year, over $1,600 a month. Suddenly, the idea of generating meaningful income from a much smaller portfolio starts to feel within reach. And this is where the trouble begins, because the critical question, the question that determines whether any of this actually works, is the same question I raised in the hook. Where is that income actually coming from? Part 2. The NAV decay problem. What it is and why it destroys portfolios. NAV stands for net asset value. In the context of an ETF, it essentially refers to the value of the fund's underlying holdings on a per-share basis. It's the foundation of what your investment is actually worth, and NAV decay is exactly what it sounds like, the slow, steady erosion of that foundation over time. Here's the simple version of how it happens. Imagine you invest $10,000 into a high-yield ETF. The fund pays you a 20% annual distribution rate, so you're collecting roughly $166 per month. Sounds great. But let's say that over the course of the year, the fund's share price drops from $10 to $8. Your $10,000 investment is now worth $8,000. You collected $2,000 in distributions during that time, but you lost $2,000 in portfolio value. You're exactly where you started, except now your capital base is smaller. Next year, that same 20% distribution rate is calculated on a smaller NAV, so your actual dollar income is lower. The year after that, lower still. You're on a treadmill that is slowly moving backward. This is the reality that a lot of income investors are living right now, without fully understanding it. They see the monthly deposits hitting their account, and they feel like the system is working. But they're not tracking what's happening to the underlying value of their investment, and when they finally do look, 6 months later, a year later, 2 years later, they're shocked to find that their portfolio is worth significantly less than what they put in, even accounting for all the distributions they received. The most important question you should be asking about any high-yield ETF you own or are considering is this: is the fund distributing income it has actually earned, or is it distributing my own capital back to me? Because those are two completely different things, and only one of them is sustainable. Part 3. The $100 Rule. Understanding sustainable distribution. Let me give you the simplest possible framework for thinking about whether an income fund is actually working the way it should. Imagine you hand a fund manager $100 to invest on your behalf. At the end of the first period, that manager has grown your investment to $110. They distribute $10 to you as income. You now have $10 in your pocket, and your $100 of principal is still in the fund, intact, ready to generate the next $10. That is a healthy, sustainable income cycle. The manager is distributing what they earned, not what you gave them. Now imagine a different scenario. You hand that same fund manager $100. The market hasn't been great, and the fund has only grown to $103, but the fund has promised a 20% distribution rate, so they distribute $20 to you anyway. Your $100 investment is now worth $83. They didn't earn that $20. They took $17 of it directly from your principal and handed it back to you. And now, they're managing a smaller pool of capital on your behalf, which means the absolute dollar amount they can earn for you going forward is also smaller. And here's the part that makes it even worse from a tax perspective. When a fund returns your own capital to you as a distribution, you still owe taxes on it in many cases. So that $17 of your own money that got handed back to you, you might owe capital gains tax on it. You haven't made any money. In fact, you've lost money, but you still have a tax bill. That is about as bad an outcome as income investing can produce. This is why the philosophy of distributing only what is genuinely earned, not manufacturing yield by returning principal, is so critically important. It is not just a nice-to-have philosophy, it is the difference between a fund that works as a long-term income machine and a fund that quietly liquidates your portfolio one monthly distribution at a time. Part 4. The gut check. How to spot an over-distributing fund. Now let's get practical, because I know some of you are watching this and thinking about funds you currently own, and you want to know, how do I tell if my fund is doing this to me? Here is the simplest gut check you can apply right now, today, without needing to understand complex options, mechanics, or fund structures. Look at the underlying asset your fund is supposed to track or generate income from. Then look at how your fund performed over the same period. They should be moving in roughly the same direction. If you own a fund that generates income on a major technology company, say Google, and Google's stock is up 15% over the past year, your fund should also be up, or at least roughly flat. Maybe not the full 15% because you've been collecting income along the way and there's some cost to generating that income. But if Google is up 15% and your fund is down 10% or 15%, something is very wrong. That divergence is almost always a sign of overdistribution. The fund is paying out more than it's earning, and the difference is coming directly out of the fund's NAV. Your fund should behave like its underlying asset. The income should be additive, a bonus on top of the price movement of the underlying, not a substitute for it that comes at the direct expense of your share price. Now, to be fair and nuanced about this, in higher distributing strategies, there will almost always be some degree of NAV softness over time. Markets don't always cooperate perfectly. There will be months where the premium income harvested is lower, and months where it's higher. A good active manager navigates that by being conservative in lean months, not over-distributing just to maintain a headline yield number, and then being able to pay more when conditions are better. That active management discipline is what separates funds that preserve NAV over time from funds that slowly destroy it. The red flag is not a single bad month. The red flag is a consistent pattern where your fund's underlying asset is trending upward and your fund's NAV is trending downward. When those two lines are moving in opposite directions over an extended period, your gut instinct is correct. Something is wrong. Part 5. Why growth plus income changes everything. So, if traditional dividend ETFs require too much capital and high-yield option income funds risk NAV decay, what's the answer? This is where the concept of growth plus income funds becomes genuinely exciting, and I think it represents one of the most important evolutions in income investing for everyday investors. The premise is straightforward. Instead of building an income fund around slow-growing, high-dividend-paying companies, your utilities, your financials, your energy companies, you build it around assets that are genuinely growing. Technology companies, innovation-driven businesses, companies that have delivered 15%, 20% annual earnings growth for years or decades, companies whose underlying value is compounding over time, and then you layer an intelligent income strategy on top of that growth. Option premium harvesting, structured in a way that generates meaningful monthly income without permanently capping the upside of those growth assets. The result, when done correctly, is a fund that does something that most income investors have been told is impossible. It pays you real substantial monthly income, and it appreciates in value over time, because the underlying assets it's built on are actually growing. Think about what that means practically. If the underlying technology assets in a fund are growing at, say, 15% annually, and the fund is distributing 12-15% in income, the math can actually work out to NAV preservation, or even modest NAV growth over time, even for investors who are spending every dollar of their distributions rather than reinvesting. And there's real data to support this. When you look at growth-focused option income funds built around individual high-quality technology names, you find scenarios where investors who took every single distribution and spent it, reinvested nothing, were still up significantly on their total investment, not down, up, because the growth of the underlying asset was doing the work of maintaining and growing the NAV, while the income strategy paid the distributions. That is what it means to actually live off your investments. Not to slowly liquidate your portfolio while pretending the liquidation proceeds are income, to own assets that are genuinely growing, generate real income from that growth through a disciplined strategy, and collect that income month after month without watching your foundation crumble underneath you. Part 6. The bigger picture, why this matters so much right now. I want to step back for a moment and talk about why this whole conversation is so important and so urgent right now, because it goes beyond just picking the right ETF. The reason income investing, and specifically high-yield covered call ETFs, has exploded in popularity over the last few years is not because investors suddenly discovered a clever new financial instrument. It's because of where we are economically as a society. Housing has become unaffordable for a significant portion of the population. The traditional model of work hard, save diligently, build a nest egg over 40 years, retire comfortably, has become genuinely difficult, or impossible, for many people. Wages have not kept pace with the cost of living in many parts of the world, and a growing number of people, including a lot of younger investors, have made a rational calculation. If I'm probably never going to own a home, if a traditional retirement nest egg feels impossibly far away, then maybe I should at least make my money work for me now. Maybe I should use my portfolio to offset my car payment, my rent, my groceries. Maybe I should find a way to enjoy the fruits of investing today, rather than deferring everything to a retirement that feels uncertain. And I am not here to judge that decision. In many ways, It is a completely rational response to genuinely difficult economic circumstances. The crowding out effect in wealth building is real. People who already have assets find it much easier to accumulate more assets, while people who are trying to get started find the barriers higher than ever. If the traditional path feels blocked, people find alternative paths. But the answer to those economic pressures cannot be throwing your savings into funds that promise extraordinary yields by quietly consuming your own capital. That is not financial empowerment. That is a slow-motion crisis that will leave a lot of people significantly worse off. The answer: if you are going to use your portfolio to generate income that helps cover real expenses, is to be ruthlessly selective about how you do it. Own funds built on genuinely growing assets. Prioritize total return over headline yield. Look at NAV behavior over time, not just the distribution rate. Understand whether your income is coming from real economic activity or from your own principal being handed back to you in monthly installments, because the difference between those two approaches, between real income investing and yield theater, is not just academic. It is the difference between a portfolio that lasts and one that slowly disappears. Closing, let me bring it all together. Everybody wants to live off dividends. That desire is completely understandable, and with the right approach, it is achievable. But the path to actually getting there requires you to be smarter and more discerning than the headline yield numbers want you to be. Traditional dividend ETFs, your low-yield, steady-growth, dividend growth funds, can genuinely be lived off of, but they require substantial capital. If you have the time and the resources to build toward that, it remains one of the most reliable income strategies ever devised. High-yield covered call and option income ETFs can also be powerful tools, but only if they are built on genuinely appreciating underlying assets and managed with real discipline around distribution sustainability. If the underlying assets are growing and the income strategy is generating real premium rather than returning your own capital, you can collect that income and spend it with confidence. What to avoid at all costs are the funds that manufacture extraordinary yields by quietly eating your own principal, returning your own capital to you dressed up as income, slowly shrinking your NAV, and leaving you worse off with every passing month, even as the monthly deposits keep arriving. The gut check is simple. Does your fund behave like its underlying asset? Is your NAV holding up over time? Is the manager distributing what they've earned, or what you gave them? Those 3 questions will tell you almost everything you need to know. At Dividend Desk, this is the kind of analysis we bring to income investing every single week, because the details matter, and the difference between getting this right and getting it wrong has enormous real-world consequences for your financial life. If this video helped clarify how to think about income ETFs and NAV decay, please hit the like button. It genuinely helps more people find this content and start asking the right questions about their own portfolios. Subscribe to Dividend Desk so you never miss a video, and drop your questions or your thoughts in the comments. What funds are you watching? What income strategies are you using? We read every comment, and many of them directly shape what we cover next. This is Dividend Desk. We'll see you in the next one.